Hi, good afternoon, everyone. Thank you all so much for joining us today for our quarterly webinar series, CIO's Corner, quarterly update with our Chief Investment Officer, Chris Gauthier. For those of you joining us for the first time, my name is Amanda Sylvia, and I'm the Client Service Associate for Stonehearth. I've been with the firm for about 5 years now, and my primary role includes client service, marketing, and compliance. I just do want to go ahead and start off with a few housekeeping items. So on your GoToMeeting taskbar, you should see a section titled Questions. Please feel free to submit your questions throughout the course of the webinar, and I will go ahead and ask Chris to answer as many as he can at the end of the webinar. If we do happen to run low on time and we are unable to get to your question, Chris or myself will reach out to you directly to make sure that we can get your question answered. Now I would like to introduce our speaker for today, Chris Gauthier, Stonehearth's Chief Investment Officer. He brings more than 15 years of investment management experience to our firm, working with both institutional and individual investors. He's responsible for setting the firm's overall investment policy and strategy, including directing our asset allocation, investment risk, research, and portfolio management functions. Chris, thank you so much for speaking with us today.
Thank you, Amanda. And thank you, everyone, for joining me on this beautiful fall day in New England. First and foremost, all of us here at Stonehearth Capital Management hope you and your families are safe and well during this trying pandemic. We do have a lot to go over today, so let's jump right in to the fun. What we'll cover today, we're going to go through asset class performance, and as we'll see, it's really been an upward trend continues from the March lows, but at a much slower pace. We'll take a look at the investment environment, which really has been a balancing act between the risks of a potential resurgence in COVID, extended equity valuations, risk of upcoming political events, against the backdrop of ultra-low interest rates, unprecedented monetary support, and a positive technical backdrop with improving economic data. And then we'll close out with looking at portfolio positioning, how our portfolios are positioned to manage risk and take advantage of opportunities, where we must be selective at all times, but remain flexible. For those on the webinar who are not familiar with Stonehearth Capital Management, our investment process is really built on 5 underlying beliefs. This really creates a framework for our discussion. It gives you an indication of how we view the markets and really helps to shed some light on our thought process. It leads to a better understanding of the conclusions we come to. So in investment philosophy, the first thing we believe in is mean reversion. Prices oscillate around the mean or the average. Price matters. What you pay for something drives returns. Valuation is a big driver of future performance. Factors offer long-term excess returns above market rates. Diversification is still the only free lunch. And risk is definitely not stationary, but really fluctuates throughout the market cycle. So with that backdrop, let's turn to Q3 performance. Really, after a record-breaking rally in Q2, equity assets represented in the green and blue bars on the chart continued to rally off the March lows in the third quarter, although at a much slower pace. Overseas had the best performer, with emerging markets represented in green right here, up over 9%, really leading the way, with the S&P 500 a close second at just under 9%. Frontier markets, represented right here in green, also had a very strong quarter, up just shy of 8%. Small cap US equity brought up the rear at slightly over 3%, still positive. Looking at the fixed income markets, which are represented by the purple bars you see in front of you, were more or less flat in the aggregate, with junk bonds or high yield bonds up almost 4% right here, and corporate credit up 1.31% right here, which outperformed treasuries, both long-term, up about 16 basis points, and short-term on the back of a very flat yield curve, which we'll look at a little bit later in the presentation. Convertibles led the way in fixed income, represented by here a 15% return, but they are not more traditional fixed income. They really possess both equity and fixed income characteristics, so they'd be expected to have a performance divergence amongst traditional fixed income assets. Assets in the alternative asset class, which are in yellow, were a mixed bag, as a weak dollar, which was the worst performing asset class, down almost 3.5%, little over 3.5%, combined with unprecedented expansion of the money supply, propelled silver to the top spot, represented right here is almost off the charts, an astounding 32% return in the quarter. With this backdrop, gold also had some nice quarter, rising almost a little over 6%. Expanding our time horizon to a 1-year period gives us a slightly different picture. You know, in terms of financial asset performance over the past year, I really have to say that, the past year has been one of the most interesting I have seen in a very long time. The markets have swayed from bullish to bearish on a whim and back again at a pace I have never experienced before. Although the day-to-day narrative may change, we can really see in the performance numbers over the long term that the upward trend remains intact, and the majority of the financial markets are returning positive performance. So looking at the equity markets, which again is represented by the blue and green bars, the NASDAQ index, represented by the ETF 2QQ, which is right here, that stands for the NASDAQ, was up almost 50% over the past year, and it really led the way, beating all other financial assets we track. In a distant second place, but still posting a very strong return, the S&P 500 was up about 15% over the same time period, followed by EM at an almost 10% rate. International equities was flat, and US small cap was actually down almost 5%. And frontier markets, which we saw had a great Q3, is still down a little over 6%. They really have yet to join the party we've seen in large cap. We'll go over a few reasons why we think that is, and why that might be a little surprising to investors looking at the headline indices. In fixed income land, again, represented in purple, convertible bonds up almost 35% led the way. But in the more traditional fixed income asset classes, duration, represented by treasuries, was a clear winner over credit in the past year. As long-term treasuries were up almost unheard of 17%, easily beating the positive single-digit returns we saw in credit, from corporate bonds at 9% and junk down at 1.5%. Again, in the alternative asset classes represented in yellow, silver again was the clear winner, posting a 36% return, with gold again a close second at 26.5%. Precious metal performance really was helped by the weak dollar and a large amount of cash in the form of stimulus that's currently in the system. Bringing up the rear is oil, falling over 25% over the past year, due to global growth concerns surrounding the COVID virus, and also a continued belief in the decarbonization of the economy by investors. So one of our core tenets of our philosophies was factors. So let's take a look at how factors performed in Q3. So what we're looking at here is US equity markets through a factor lens. We look at the value factor, the quality factor, momentum, BYM, which is income, and compare that against the S&P's 9% return in the quarter. And what we see is that momentum was the clear winner in Q3, up almost 13%. This momentum factor represents stocks in the US that have performed well over the past year or so. In fact, it was the only factor to beat the S&P 500 index. The worst performing factor, as has been the case for a while now, was value, down a little under 3%. And that trailed the S&P by around 6% on a relative basis, and trailed the momentum factor by a whopping 10% in the quarter. This divergence in factor performance has been in place for a while now, and we're going to take a look at one of the potential underlying causes of this gap further along in the presentation. But before we do that, let's take a deeper dive into the equity market characteristics, starting with how we got here. So we can see, we're looking at the long-term price performance of the S&P 500 index going back to 1996. You see ups and downs in the marketplace, but again, really a nice strong rally off the bottom in 08. Now we do see this little dip here, given the pandemic we saw in the beginning of March, but we've had a very nice rally off the top. And really what we look at here is this rise different than what we've seen before in the marketplace? Is there something at the extremes? Is there an outlier? And we kind of look at the PE ratio, which again is just what you pay for earnings, so how much you're paying valuation, dividend yield, what stocks are yielding, and compare that to the other options we have in investment, like the 10-year treasury. So going back at other previous peaks, March 24th, 2000, we all know about that, 2007 before the GFC, February 19th before COVID really hit and felt in the financial markets, and the current environment right now. So you can see from a PE standpoint, we're pretty much in line with previous peaks in the market. Back in 2000, we're at 27. We're only at 16 before the financial crisis, but again, back up at 19 before we hit, and we've really come back over that to 21 after dropping to almost 13 at the bottom of the COVID. Dividend yield, pretty much in line where we have been at previous peaks, 1.4 back in 2000, and we're at 1.8 now, pretty close. The big difference you notice right away is a 10-year Treasury yield. Back in 2000, you could get 6% risk-free investing in the government if you think the government's risk-free, which we do in the marketplace. Compared to before the COVID crisis hit, we're up at 1.6, very low, but again, still positive, and down to almost 0.7 right now. So it is a big difference in the marketplace, and we'll see how that reflects in valuation picture. So let's turn to the valuation picture of the S&P 500. Again, what we're looking at here is the PE ratio over time, going back to that same 1996 timeframe. We can see here that the 25-year average is averaged around 16.5. We're up at 21.54. So again, elevated to say the least compared to history. It is almost over one standard deviation away from historical average. So what does that mean for those who don't know statistics? It's very high, very elevated, and it's at an extreme level. Looking at those indicators that we look at, forward PE we saw in the previous chart, but we also look at the CAPE, which is a version of the PE that takes a 10-year average of earnings compared against the current price and takes into account a full business cycle, pointing to the same picture, still much higher than history, a little under one standard deviation away. Looking at the dividend yield, again, low compared to standards. Price to book, another way to look at valuation. How much are you paying for all the fixed assets in the equity market? Again, 3.5 compared to historical 3, very high. How much are you paying for cash? So again, we know earnings aren't cash, which is how much cash is a company generating. Again, you're paying almost all-time highs, almost 2 standard deviations away from historical average. The one bright spot and the only positive that anybody can hang their hat on from valuation is a relative gain compared to treasuries. And what this does is just look at what the earnings are on the S&P, what that yield is on the price, so the inverse of the PE ratio, and compare that to what you can get on treasuries. And again, equity market looks cheap on that. Again, a lot of the Fed intervention, trying to move people up the risk curve, making the fixed income asset class so unattractive that you're forced to go up to the equity curve. So again, it's not really a reflection on cheapness in the equity markets. It's really about the Fed intervention to the bond market, trying to push people to the equity market. Now, a big piece of these future valuation ratios really depend on the denominator, right? Earnings. Can they grow? Will they grow? So let's take a look at what we can expect from earnings going forward. We're looking right here is charts from Goldman Sachs in first column. It's pretty much what we consider consensus. And we look at multiple different earnings estimates, but this is pretty much in line with consensus and gives a nice idea of what the market's thinking. So looking right here at 2020 estimates, it's looking for EPS of almost $130. Represents a 21% negative year-over-year growth. The interesting thing to me here is that when we look at this number, this means the companies are making less than they did all the way back to 2011. But with the combination of incredible monetary stimulus and a synchronized global economic recovery, we're pointing to a recovery in earnings to almost $170, a 30% growth rate right here. Again, these expectations for 2021, looking past COVID, looking past where we're going to be. And this is according to consensus. While 170, it's a tremendous year-over-year growth rate of 30%. This would really only bring us back to 2019 levels when the S&P companies earned about $165. So earnings season is really just begun, but what we've seen so far is so far so good. And then hopefully as more results roll in, the positive numbers will cause an increase to this $170 in 2021 expectations. That would provide some nice support for further gains in the market. And we're really seeing that at least in the beginning numbers. So before we leave the US, I would like to take a moment to go over that growth momentum, divergence in performance we talked about, the spread between growth and value we saw in the previous slide, and really look at the potential implications for headline index performance going forward. So as I'm sure you've heard, if you follow any kind of financial news, that we're having record equity concentration in the indices. And really it has to do with what we call the FMAGA. And I shouldn't say we, everybody in the industry calls it FMAGA. And FMAGA stands for 5 stocks, make up the biggest piece of the S&P 500. They stand for Facebook, Apple, Amazon, Microsoft, and Google. So as you can see here from the chart we're looking at is the 5 largest companies of the S&P, not just these 5, but throughout history, if you take the top 5 companies in the S&P, how much weight they are in the index. And you can see it does fluctuate to lows of like 10%, up at 18% back in 2000. So I want you to remember that number. So you don't have to remember it exactly, but we'll be focused on that. And that was a previous peak in concentration. You can see we've blown through that. We're out, we come down a little bit due to COVID, but we're still up at record concentration levels of 23%. The impact of this in terms of performance and what we're seeing between the growth and value is these 5 stocks are what we consider growth stocks. They're very heavily weighted in the growth factor. And given this record level of concentration that has come from this outperformance, they have a very high weight in the momentum factor. So they end up as a large weighting in the momentum factor. So this large concentration in the index can lead to performance divergence in the headline index and other factors in comparison to markets as a whole, which can be seen in the next slide. So we're taking those same FAMAGA stocks. This is as of October 17th. And we look at the return year to date. You can see that they're up a very good 40%, which again impacts that headline index because they make up almost 20% of it. And you can see the S&P 500 at the same time frame, it's up a nice healthy 6%. But going underneath the hood and looking at the data gives you a little bit different story. Taking the rest of the S&P, right? The rest of those companies, those 495 companies, those 80% of the market cap, they're actually still down on the year. They're down almost 1%. When looking at this, again, one of our tenets is mean reversion. This could potentially help those remaining 495 companies. Many of them are oriented to the value factor and are of a smaller cap nature. So why is this potentially important for future price performance? Well, we can look at history as a guide. And I told you to remember that 2018%, which we can see right here. And back in 2000, it was Microsoft, who's back in play again, but other names we don't see today, Cisco, GE, ExxonMobil, and Intel, and they made up 18%. Well, we can see going over time, you can see what happened to these 5 largest stocks at this previous high. The concentration dropped to almost to about 7 or 8%. The weight was, and since this is a market cap weighted index, the reason for this weight decline was relative underperformance in price. And this was to blame to the decrease in weight. So again, looking at history as a guide, can these 5 stocks maintain this high weight in the S&P 500 index? We don't have a lot of data points. There's not a lot of history to this. But the last time we saw a concentration this high in just a select few companies, it didn't turn out too well going forward over the next 20 years for those companies. We just have to wait to see how it plays out, but it's something to keep in mind as we look forward for equity price performance. So turning to the global markets, and what we're looking here is around the world, the S&P, China, Japan, England, France. And while all the markets had a nice bounce off the bottom in March, which is represented here, not all bounces were the same. As you can see from these top 2 lines here, there are really only 2 countries that are above 0 on a year-to-date basis are China and the US. They're only ones to turn positive. The rest are still lagging behind by a great deal. Again, we talk a lot about mean reversion. We've mentioned it before. It's a very powerful force in financial markets, and it may provide a nice tailwind for the overseas markets here to catch up. When we look overseas, we also see some nice valuation support from international EM markets, as can be seen on this next slide. So we're looking at relative valuation compared to historical levels. Emerging markets on the left, developed international markets on the right. Think China, South Korea. Over here, you're thinking Europe, Japan. And we're at all-time lows in the discount investors are applying to overseas markets. And the question you have to ask is, do they deserve this discount to the US? Yes, but not to this extent, not to this extreme. You see, throughout time, our emerging markets have traded at a discount to the US of almost 0.69. So again, using price to book, what investors are paying for assets on the balance sheet, they pay a little bit less for emerging stocks. Same thing when we look at developed markets, when we look at the price to earnings ratio. On average, they paid a little bit under 0.9 compared to the US, but we look at the current levels, it's really at extreme levels. You know, and what we've seen throughout history is that extreme levels, mean reversion tends to take over. You know, and what we've seen recently too, in this very small data set down here, you can see a nice little uptick, and the same thing with international. So it's headed in the right direction to close this gap. And the relative valuation support we're seeing may provide a nice opportunity for investors going forward. So leaving the equity land and turning our sights to fixed income, which, like the equity markets, is being heavily influenced by the Fed, only more so, as the Fed is in control of the yield curve, which is the basic building block of fixed income assets, which we're looking at right here. And as hopefully we know, all fixed income pricing and performance begins with the level of government yields, represented by the yield curve shown here. It is what the government pays to borrow money over multiple time frames, ranges from the very short term, to borrow 1 month, cost the government about 0.1. That's the Fed rate, that's the headline rate you see announced almost every month, out to 30 years, which cost the government 1.5%. So when we're looking at the yield curve, remember, the Fed controls the short end, but the short end heavily influences the long end. So control the short, heavily influence the long. By setting short-term rates at record lows, they're keeping borrowing costs down for both the government and also private borrowers, which again, trying to stimulate the economy, providing some support. The current rates are represented by the blue line right here, and the gold line is the beginning of the year. And you can see this massive decline across the tenure, whether it be 30 or 1 month. You see the decline rates as the Fed stepped in reaction to the fallout from COVID. This really did stabilize the market, and it did help lead to the bounce we've seen this year in risk assets. We didn't see a lot of movement in the quarter. As the beginning of the quarter is this aqua green line coming here. We did see a small pickup in the long end. So it came in at 1.4, ended at 1.5. But again, these ultra low rates are across the board. It's really helping borrowers, both individual and corporations, as can be seen in the spread analysis on the next slide. What is spread? Spread is relative to rates we saw on the yield curve. It's how much you have to pay, whether you're a corporation or taking out a mortgage, above the government rate to borrow money. The higher the rate above treasuries, or the spread, so the higher this goes, the more risky the asset class is considered and the higher they have to pay. So in terms of what we're looking at here, lower is better in terms of when we're looking for stress. As you can see, back in the global financial crisis, the best way to look at this, you can see yields blow out, which means they rose tremendously. So again, this indicates financial stress in the marketplace. And we look at spreads across all fixed income land. We're looking at investment grade corporate, so corporations, the US high yield market, corporations that aren't as investment grade, mortgage-backed securities, and US government agencies. You see spreads across all fixed income land have reverted back to the historical mean. So what we're seeing is they're not at extremes yet. They have declined. And what this means is there's no distress in the marketplace according to the spreads. Companies can still borrow money. And given the ultra low rates the Fed has placed in, these spreads can make borrowing very cheap for companies and keeps them afloat through these trying times. We are watching these spreads very closely for any signs of distress. So we're really looking for these pickups here because this would lead to an indication, indicate a possible trouble ahead for risk assets like equity. So we've seen that the Fed has been successful at providing support, but it's not a free ride. As the low spreads we're seeing act as a cost to savers and lenders alike, as can be seen on the next slide. And again, we can see the fingerprints of the Fed's intervention all throughout the data. The Fed's lower for longer has lowered the yield available to investors, represented by the blue bars. So again, we look at tips to negative yielding, treasuries 0.5 on average. Again, it's across the tenure, either 1 month to the 30 year. Corporates yielding 2, intermediate corporates 1.4. To the other end of the spectrum, where we have leveraged loans up almost 5, and high yield corporates almost at 6%. So, I mean, this yield is really balanced against the risk of rates. So historical safe income asset classes, kind of by broad corporates, treasuries, is really distressed because of the Fed. And you have to take a lot of duration risk, which is represented by this green line here. And duration risk is the risk that rates rise. So all we're looking at here, if rates rise, potentially the price of that instrument could fall by that amount. So again, what we see in the marketplace with the Fed's intervention is that they've made traditional safety of income, again, those people who are looking to save money just to generate some income in a safer manner, has been really made a risky asset class by the duration risk. And some of the better opportunities may lie in other asset classes that the Fed is not directly intervening in, like high yields, which we'll see later. So in addition to rates, the Fed really has other levels to pull. to support risk assets, and pull they have, as they can be seen by the tremendous rise in the money supply in the system. The Fed balance sheet, right here, up at almost $7 trillion, and M2, which is the money supply, remain elevated, providing liquidity to the financial markets. So what we're looking at here is, where does all this money supply come from? This is just the amount of supply in your checking accounts, your savings accounts that you use to transact every day that's floating around the system, that's on your balance sheet. How is this generated? How do we get this massive increase in response to the crisis? You can see right here, it's from the Fed, the balance sheet. They take assets out of the system, out of your hands, out of your portfolio manager's hands, and replace it with cash, which hopefully generates economic activity. We are seeing signs of that, which is a good sign, which is why the equity markets keep rising here. But again, the level of debt is tremendous. And this really isn't just a US phenomenon. It is truly a synchronized global movement by central banks to provide liquidity in support of risk assets. Government and central banks around the world responded very quickly in an unprecedented fashion to COVID. And you can see right here, when looking at balance sheets of not just the US, which is labeled by the Fed here, but the Bank of Japan, European Union, the Bank of England, all increasing the leverage on the balance sheet, again, to generate and distribute cash into the economy to hopefully generate activity. And we see no end in sight, as market expectations, which is everything to the right of this forecast, is for a continued rise in their respective balance sheets. And nary a rate hike to be seen anywhere in the world, which is represented on the chart over here on the right by EM and DM central bank. You see cuts right here in 2020 dwarf any type of rate rises at all we're seeing in the marketplace. So taking a step back, we see that all the central banks are trying to intervene in the marketplace. And the question we need to ask is all the support working? Well, let's take a look at the economic data to try to find the signal to the noise. And the first thing we'll look at is GDP. And it definitely didn't help the GDP in the second quarter. The US economy shrunk by over 31%, almost off the charts in Q2, again, Q2 2020, which is numbers reported with the lag, compared to recent history. This has been the worst quarter since the Great Depression. The one problem with GDP number is that it is a backward-looking number. It is a great indicator of what happened in the economy. But that doesn't help us when we look forward. We're more concerned with what is going to happen. And for that, we need to look under the hood of the headline GDP numbers and see what they can tell us about future conditions. Again, try to find the signal through the noise. So let's start with the employment picture. And what we can see here on the left is the massive amount of job losses due to the COVID pandemic. But we're seeing at least the beginning of a rebound in the data. Again, it's tough to tell because the lines collapsed so much, but you can see it down here in the beginning. And right up here, you can see the rise. So about almost halfway back, pretty much. We'll be watching this jobs creation number very closely for continued improvement. And the chart data does say we do have a very long way to go, but as can be seen in the data, we're at least headed in the right direction. And the job losses we saw, were heavily concentrated in industries you would expect, given the crisis we face. You can see leisure hospitality, 50% back, trade and transportation, but they were the majority of the job loss, education and health services. So again, a very uneven job loss in terms of this pandemic. And and when we look at the unemployment rate, and just recently the last number came in just below 8%, again, which is a massive improvement from what we're seeing with all these jobs being created, but it's still well below the norm and the full employment rate, the Fed's definition of 4%. So turning to a bright spot in the economy, let's look at the housing market. After an uptick in housing starts last month, represented by the green line right here, home sales increased by over 12%, which is represented by the blue line right here. In fact, housing starts have risen in 4 out of the past 5 months. Housing prices, represented in pink right here, have continued to climb higher during this pandemic, really thanks to historically low mortgage rates. Again, that's the Fed intervening in that rate yield curve, which are heavily influenced by the yield curve. Again, there's that Fed influence again. So what are some of the drivers of this? Again, in addition to the low rates, reaction to the office closings, a potential change in the work environment. It's much easier to work from home. People are looking to move out of the cities and move into the suburbs, again, without that commute. It's really pent up demand for housing and a very low supply. And like we talked about, perhaps the biggest influence, and we look at current mortgage rates, they're currently in the low 3s for a traditional 30-year fixed. which are near historic lows. Bodes well for the future, as a robust housing market does provide a catalyst for economic activity. Just think about it. Whoever bought a house before or sold the house, you're hiring movers, creates economic activity. You do repairs, upgrades. You probably buy some new furniture, some appliances. This all increases economic activity that flows through to industries you wouldn't even think about when you look at the housing market. But when we see this increased economic demand combined with the low rates from the Fed, this has usually been a good recipe for higher inflation. It hasn't worked yet, and really in the beginning of the year it hasn't if you use the Fed's measures. But we're starting to see it perk up a little bit, and we're starting to see signs that we may be at an inflection point in inflation. We can see the headline inflation numbers that you see reported every month on the left, called the CPIs. This core, which just takes out energy and food as they're more volatile. And you can see that while still below the historical average of 2% and the Fed target, they are headed in the right direction. Again, common theme you see when you look at this economic data is a massive decline in the data, but a rebound off the bottom. And really the question is, will this rebound continue? This tells us kind of where inflation is. To measure inflation expectations of where it's going, we use the break-even rates, as can be seen on the right hand of this slide, which simply uses the spread between treasuries, which is priced on basically inflation, and tips, which takes out inflation because you get compensated for that. And that calculates what inflation rate investors are pricing into the market. When it's headed upward and to the left, investors are expecting an increase in the inflation rate. It did roll over a bit in the back half of the quarter, but really not enough to change this upward trend in the data that we're seeing. So when we look at inflation, inflation is not always bad, and a little inflation would go a very long way in generating economic activity, as expectations of future price rises has the potential to, again, motivate current economic activity. You see where the Fed's going with this. They're trying to create economic activity. So you think about it from your standpoint, why put off a purchase if it's going to cost more in the future? Although too much inflation without growth can be a bad thing, like we saw in the 70s. We're not close to that tipping point yet at all. We'll be watching this closely because we do need a little bit of inflation. So expanding our economic view to the world stage, we get the same economic picture we see in the US, a continued rebound off the lows we saw in the first half of the year. So what we're looking here on the left is a level of positive surprises in the economic data as measured by the Citigroup indices. They've started to reverse, but still remain positive. So all this takes is looks at all the economic data that's reported every month, every quarter, and looks at, did they beat expectations or did they come in under expectations? Above zero means economic data is turning more positive than what we thought it was going to be. Below zero, turning more negative. So again, anything over zero means the economic data is coming in better than expected. So you can see we've reached a peak in the beginning of the quarter and have declined a little, but still remain firmly in the positive. We're also seeing positive signs in the manufacturing surveys around the world, as the PMIs, shown here on the right, are firmly in expansion mode around the world, as can be seen in the data. A reading above 50 indicates an expanding economy. So that's the traditional economic data we look at. Given the increases in technology advancements we've made over the multiple years, we have different ways of looking at economic activity in more real-time data. Very 1984-ish, if you think about it. But we have a way of looking at the data in real time. And this non-traditional economic data confirms the thesis that we're seeing that the economy is bouncing off historic contraction. And while we have a long way to go, we are at least headed in the right direction. Again, upwards and to the right is good for this. We saw a strong bounce in retail sales, represented by this purple line here. You can see that at the trial, it was down 37%, and it's only down 4% from pre-COVID levels. So consumers are still willing to spend, but what they spend their money on has changed recently, as we've seen with online purchases and things like that, and less air travel. So we see the strong numbers in housing. You can see right here the purchase mortgage applications up zero and back to pre-COVID levels. And then again, we look, most had a bounce. But like air travel and restaurants, but have been trending sideways lately after a reflexive rebound from the lows. And look at that, you can see airline travel, which is the TSA traveler check, down still 70%. So we've seen a bounce, but it really hasn't moved a lot since June. and still down 70% from pre-COVID levels. And looking at seated diners, down 43% from before the crisis. Not really sure they'll ever get back to it, but again, given the high level of consumer spending on other things, they're changing their spending habits, we still see a path for economic recovery here. So any turn down in this real-time data would give us pause for concern that the economic rebound we are seeing will continue, and which would not be good for the risk environment. So before we get to our model and portfolio positioning, we need to take a moment to discuss the political environment. Not my favorite subject to talk about, but the impacts from the November 3rd election is currently having an outsized influence on financial markets, and it could potentially have long-lasting impacts for the risk environment as 2021 unfolds. It's surprising, but it's only 11 days away, and the only good thing I can say about this election is that it'll be over soon, but I digress. So what we're looking at here is data from the Predicted website. This is a website where anyone can place wagers with real money, real dollars, on an expected outcome of any event, including the election. So what we've seen over the past month or so is that election certainty on the Predict data is helping the markets. The wider the gap for either candidate, the harder it would be to claim the election is illegitimate. So markets like certainty. So when we look at the data here, we're looking at the possibility for a Trump victory is in blue and a Biden victory is in green. You can really see the bottom fill up for the President Trump in the data with the first debate and the COVID diagnosis. You can see that right here. This weakness also transferred to the Senate. So again, this is the probability of a Democratic sweep on November 3rd has definitely increased. It is not the base case yet. It's only at 30%, but it's definitely, the odds of it happening has definitely increased. When we look over here, again, we look at the Democratic sweep, you can see the Senate control follows the same path of the Trump and Biden. So again, this spread we saw is helping the markets because we see certainty, right? No one can claim illegitimacy if the spread is wide, and we're seeing that spread widening out. So I'd like to take a look now at the potential fiscal policy impact of a Biden win, because according to the predicted data, that is the most likely outcome at almost a little bit over 60%. And again, not guaranteed, not certain. There is 11 days, and if we learned anything in the past 4 years, anything can happen in 11 days. Just be prepared for anything. But again, as looking at it right now, it does seem Biden is on his way to victory based on the Predict data. So looking at Vice President Biden's policy, what he said, it's not 100% stimulus. I mean, his core platform is over 7 trillion new spending, which is in the dark blue here. You can see education and healthcare, infrastructure and R&D, housing. Again, 7 trillion new spending. But what gets lost in the noise sometimes, it's offset by almost 5 trillion rise in taxes. You know, corporate rate goes up by $1.4 trillion. And I'm saying T, trillion, not billion, T, trillion. RX drugs, payroll tax. This would be one of the highest tax increases we've seen throughout history. Again, granted after we just lowered taxes, but again, the numbers are what they are, and it would be almost unprecedented then to tax rise. We do have to be careful when looking at plans, because plans are certain, they're out there, but converting them from policy to law is no sure thing. But as President Obama famously said, elections have consequences. And I do believe one of the consequences of this election, no matter who wins, and you can see in the numbers, there's going to be a much higher level of debt in the US going forward. So now taking a break from what the investment environment was, let's turn to our model and try to find the signal from the noise. So what I'm looking at here is our Stonehearth capital risk model. Going back to the beginning of the year, we've seen, again, this is how we ended 2019, first quarter, second quarter, and where we stand in the third quarter. And when we look at these third quarter numbers compared to where we've been, we see major improvements in our model throughout the quarter. And it's just jumped almost 7 points from a -3 to a +4. So it's a positive sign for risk asset classes that things are getting better in the marketplace. When we look at under the hood and individual indicators, we look at the technical indicator. We have structure and reversion. And we saw that up by 2 as the structure of the market has shown marked improvement. So the right parts of the market are outperforming. We see nice support in that, in the structure of the market. Our reversion indicators, which looks to inflection points, looking for changes in trend, continue to point to an upward trend in the market until proven otherwise. So a very positive technical picture which would be expected given what we're seeing in the marketplace and the price rise. Turning to valuations, really no change, and we saw that in the previous charts we've looked at. It does remain firmly in the negative camp at a -4, which is really holding back the score to be more positive. The biggest improvement we saw really came from the economic data, as it rebounded from almost a -2, not almost, a -2 last quarter, to a +3 in the quarter, a rise of 5. So again, we see massive improvement, a massive bounce off the bottom. Again, we're not fully back to where we were, but we're heading in the right direction, and the data keeps coming in positive as 2020 rolls on. In terms of our qualitative measurement of the market, we're at a neutral, and which is where we have remained. And again, this is a number that really calculates from us investment committee meeting, where we look at the 4 of us, look at our collective history, and what we're really trying to do on the investment committee is really balance the unprecedented monetary support with the risk of political discourse, in particular with the stalemate over a new round of stimulus from the government and a resurgence in COVID. So given that balancing act, given the risk and rewards in the marketplace, we don't think qualitatively we rate more than a neutral in the marketplace right now. So taking a step back, taking a weight of the evidence approach, we do see the data leans positive as you have rebounded off the lows, but it remains a fragile recovery due to the higher level of risk of an external negative event due to the continued presence of COVID and the lack of a vaccine in the marketplace. What we do see that risk appetite is improving, and we do expect volatility to remain elevated, and that means investors will need to remain flexible in responding to the fast changing environment, and it'll be critical in investing during these trying times. So that's the investment environment. That's our model. We see things getting better. How does this translate into our portfolios and what we're seeing in the marketplace? We're looking at asset allocation based on our core moderate portfolio. We also have conservatives and aggressive portfolios, but again, they all lean the same way. We're just using moderate here. And we did raise the level of risk in portfolios from the quarter by reducing cash in our portfolio. We're still overweight cash, which can be seen here by the green bar. But for conservative clients, we added 4% to corporate credit exposure based on the attractive spread levels we saw, but not at extreme levels, and they're low enough where corporations are healthy enough to borrow, and really this rebound in our risk model that we saw. For our moderate and aggressive clients who can take on more risk, we increased our US equity exposure by almost 5% as we added to emerging markets. Again, we like the valuation picture, we like the growth rates, and US momentum stocks, which have performed very well, which narrowed our equity underweight. Again, we narrowed our equity underweight. We're still underweight risk assets other than emerging markets, but again, we just closed that gap, so we get closer to the benchmark weight. We're underweight US and developed, but incrementally turning more positive, but we do see better opportunities elsewhere like emerging markets and in some of our opportunistic plays, which we'll look at in a second. Overweight EM, we talked about the valuation picture. We do remain selectively overweight fixed income with an overweight to high yield, corporate credit, mortgages, and as we saw with the inflation protected securities, because we do think that's rising. We balance that with an underweight to treasuries and duration. We do not like the duration risk return here. We do like active managers in the fixed income space that have the duration flexibility in the mandate. So again, we do like those more active managers in the fixed income space. We're still overweight cash as a ballast against volatility and to take advantage of opportunities as they arise in the marketplace. We are overweight our opportunistic bucket, and really this opportunistic bucket consists of precious metals like silver and gold, which has been great for the portfolio, frontier markets, which we saw as a nice performance in the quarter, and also an exposure to managed futures. So that's how the portfolio is positioned. That's the data. So what is the high level sum up of our thinking? Well, as always, proper risk level is key for individual investors. Having a healthy exposure to equities or risk assets is still called for, but you don't want it to be a hero or jump out on a limb here, given this increased volatility around the political environment and a possible COVID resurgence. And really, you need to maintain flexibility and stand ready to take advantage of any opportunities as they arise in the marketplace. So, final thoughts. What have we learned today? What we've learned is a massive amount of monetary support, and it's helping keep the markets afloat from the Fed's balance sheet. Massive amount of support is leading to record levels of debt. You see that all over the place. Not a problem yet with rates so low, but could lead to surprises down the road and not good surprises. The economic recovery is proceeding, albeit slowly, and not back to pre-COVID levels, but it's headed in the right direction. So you saw that inflation is starting to pick up in the economic data with, again, a little inflation is a good thing. A lot of inflation, not so good. But given where we are in the current inflation rates, we need to see inflation keep moving forward, and that'll be a positive for the market. Equity valuations across the board are still at elevated levels, but there's still pockets of decent valuation support in terms of EM and overseas. Don't forget about the upcoming election. This could change in a dime, and see what happens with the outcome. Also be wary. I mean, this could be a COVID resurgence and a status of a vaccine. These are unmodelable, unpredictable, but you need to be prepared for it. You need to have a plan in place for when or if these happen, you are able to take advantage of your portfolio and adjust accordingly. And finally, stay flexible with portfolio positioning as the situation remains highly volatile. This appendix, and for our lawyer friends out there, it's our compliance disclosures. I'm sure you've read them already, so we'll go with that. And with that, I'll turn it back to Amanda to see if you have any questions.
Hey, Chris, thank you so much. We do have a few questions. So just as a reminder, there is a questions bar there on your GoToMeeting taskbar. If you'd like to submit some more, we'll try and go through some of these. And if we do happen to run out of time, we will reach out to you individually to make sure we get your question answered once we're done with the webinar. But Chris, just to start off here,
Sure.
The first question I have is, if Biden wins the election, how do you think his policy will impact the oil market?
Someone watched a debate last night. Negatively for oil markets, I think, again, we talked about translating policy into law is always a challenge, but his leanings are towards a decarbonization of the economy. He believes in climate change. He believes in investing in clean energy. All those lead to a negative impact on oil. I do think long-term structurally, it doesn't matter if President Trump gets reelected or Vice President Biden gets elected. I think all the world is changing. We are moving to a decarbonization that no matter what president is in place, it may go faster or slower, but we're heading down that path and there's nothing to stop us. So I think what President Biden's cabinet would do, it would speed up that process. But again, I don't think there's any way to stop that. So again, I do think it's a negative impact in oil. We don't have a lot of exposure in our portfolios. Frontier markets are oil producing countries, so they have some exposure there, but they also have better growth rates and expanding middle class. So there's other ways that they can generate returns. So again, a Biden presidency, or it's negative for oil, but I don't think anything can be positive for oil when we look out longer term. It is headed lower and lower for longer.
The next question I have is, will the Fed keep providing support if inflation is greater than 2%? What happens to the equity market if they pull the support?
Good question, two parts. I'll answer the easy one first. If they pull their support, equity markets go down. There's no other way to put that. Again, they're not the only game in town, but they're the major players and the major pillar of support for the equity markets and markets in general, credit markets too, not just equity, fixed income markets, borrowers, the housing market. I mean, they're kind of the lender of last resort and the kind of adults in the room saying there is a crisis out here and we need to provide support. And hopefully our politicians in Washington will get on board with them. In terms of pulling the support with 2% inflation, it's interesting. Again, historically, the Fed has always said, dual mandate, keeping pricing stable, which means inflation at 2% and full employment. During the quarter, Jerome Powell actually changed that mandate a little bit. He came in and announced that, 2% is not the target. We're targeting 2% on average. So what does that mean? Is that after historically low inflation for a while, they'll let inflation run a little bit hotter. So the average inflation rate over long time periods averages 2%. So the takeaway is that they're going to let inflation run hotter and higher for a lot longer. And this is a sea change in what the Fed has said before. So again, that gives impetus for lower for longer, and that inflation is good for the marketplace because they're going to let that run a little bit and really make up for the low inflation we've seen really over the past 10 years in the Fed's numbers. So again, I don't see inflation driving them to pull support. I think increased economic activity, which would be a good thing. But again, I don't see inflation given their changed the policy in terms of using an average inflation rate. So you could see inflation rates 3, 4, 5% for a while, but when you average that with the 1% we've been seeing, we still get to the 2 and no need to raise rates, which is a big change what we've seen in history, because before, once it hit that 2, they'd raise rates and they've hurt recoveries before. So if they pull support, it's bad across the board for equity markets, for mortgage markets, for all financial asset classes, but we don't see that happening due to inflation, given the mandate of an average inflation rate of 2%. And it would take inflation running very, very hot for a long time to get to that 2% average rate.
Just to go back, because we have a second question here.
Sure.
So maybe you can give us some further thoughts. The question is, how does Stonehearth feel? How does Stonehearth feel will happen in the market with Biden when compared to a Trump win? So I guess earlier we had discussed if Biden were to win, do you have any further comments as far as comparison between Biden and Trump?
So when looking at the market outcome, we're really looking at expectations, right? The market doesn't price in outcome to events. They price out what they expected the outcome to be and then react to what it actually is. Right now, we look at the polling, the majority of the polling, there's other polling out there. We look at the predict markets. We look at how some of the asset classes are trading that would benefit from either presidency. I think they're really pricing in a Biden victory. I do think we concentrate on the president a lot because it's such high profile, but I think the real question and the real worry of the markets is what happens to the Senate, right? Because when we looked at the data, we looked at the House, is pretty much everybody agrees the majority that it's going to stay Democratic. It's almost up at 80% chance that happens. The presidency seems to be leading Biden lately, but again, president can't make law. They can only enact current law. Laws made in Congress, in the Senate, and right now the Senate is Republican controlled. It is leaning Democrat a little bit in the polls, but it's very tight. It's a 50-50 at best that it changes to Democrat. And I think that's what really would spook the markets, not so much a Biden presidency or a Trump presidency, because we know what we're going to get with both. It's really that Democratic switch. And what they're really worried about is that, is there a Biden presidency, a Democratic Senate, Democratic House? You know what's going to happen. There's going to be more spending. There'll be more taxes, not right or wrong, it's just their stated policy. And there'll be less of that if a Trump wins. So I don't think you can play elections in terms of short-term performance in the marketplace. I do think that the markets really want somebody to win. So what we're looking for and what we're nervous about is a contested election. As long as there's a winner, a clear-cut winner, and a clear-cut person who's willing to say that they lost on both sides, then I think that's all right for the markets and we won't see anything. If there's a contested election, you're going to see the market go down. So again, to sum up what we see, we don't think it's a tradable event. You may get some short-term volatility in reaction to the headlines, up 1%, down 1%, but when we look out a week, 2 weeks, 3 weeks after a confirmed victor, we don't see it having any impact on performance. Once we see the makeup of Congress and we see the laws that can actually enact, we can adjust portfolios then. So we don't think it's a tradable event. We don't think either one is good or bad for the marketplaces. We know what they're going to do. There's going to be more debt. There will be impacts within equity markets. But overall, I think as long as we have a winner, I think the markets will be very happy with the outcome, at least in the short term.
Okay, moving on here. This is kind of a long one. It says, there is a saying that the only people who made money in the gold rush were the ones that made picks and shovels. I don't think it is possible to pick the winners in the electric car market, but is there money to be made in the supplier side of this market? Battery producers, for example.
Yes, yes, yes. So again, this question we get, this is always at Tesla, right? They're the leading electric car maker. Their price has been through the roof, but they don't make any money. Well, they're starting to make a little bit of money now, but they don't have a long production run here. So again, do you buy the battery makers? The problem with that is Tesla's one of the biggest battery makers. They do have a big battery plant. So you're investing in them, but you're also investing in their car production as well. All the other battery companies are in China who have their own issues out there. I do think looking at BYD over in China would help. I do think buying a basket of clean energy stocks is a better way to play this. Again, identifying winners and losers is tough sometimes, and it's such an early industry, but you know this industry is going to win. So we look at terms of ETFs like ICLN that invest in electric cars, also solar, also wind, but the entire clean energy infrastructure. And if you want to invest in electric cars, it's interesting. I would try to BYD for the battery company, but again, you have to go over to China to get that. I think it's more a basket of stocks because you can't expect when you include some Tesla, some GM, VW, all the ones that are creating electric cars.
Chris, in the essence of time, I think we're just going to stick with one more question. So if we didn't get to yours, Chris or myself will reach out. So the last one we have here is what, if anything, would change your outlook about what you discussed today?
Good question. Something we always look at here. I think a few things we're watching. We're definitely looking at credit spreads, right? So we looked at credit spreads. We looked at them all right around long-term averages. We're really watching those to see if those widen out a little bit. And then what that seems is this distress in the bond market. And that'll kind of manifest itself before we see that in other risk asset classes. So we're really watching that closely. And the real-time economic data, again, technology advances are great and they help us give more information, and the more information, the better. And that'll give us a real-time indicator of where this economy is going. And again, it doesn't have to be straightwards and upwards to the right. As long as we're moving in that right direction, I think that provides enough support for our underlying thesis that things are getting better. So again, really looking at the real-time data and looking at credit spreads is really going to tell you which way this market's going to go. So if we saw any kind of distress in those two indicators, it would really change our outlook. That being said, there's a whole bunch of things out there that we can't anticipate that could change our outlook. There could be a contested election. There could be a crisis. There could be a war over in Europe. You just don't know. So again, those are the ones we're looking at right now, but we're constantly looking at multiple risk things that could change our thesis. But those are the two things we're really looking closely at now in the short term: credit spreads and distress in the markets.
Chris, I just want to thank you again for hosting CIO's Corner this quarter. As always, we do it every quarter. You can check back on our website once we get some dates up there for 2021. So the next one will be in January. We hope, at least for our clients, we'll get to talk to you before then. But if not, thank you so much for joining us, and hopefully we have a better end to 2020 than we've had all year. So Chris, thank you so much for joining us.
You're welcome. I second that thought tremendously. Better 2021 around the corner.
All right. Thanks, Chris. Take care, everybody.
Thank you, everyone. Stay safe.